you would always find people talk about, using indicators, and then you find them talking about how indicators can tell them to buy and to sell. Just listen to the choice of my words. Looking for indicators to buy and to sell. You see, the point is, indicators could serve as, a way of making decisions in the market. Indicators could also serve as a means to which you could also make decisions in the market. Indicators could also provide a pathway to which you make or take your trades in the market. The one we're about to teach you today is not the one to which you're going to ask an indicator, should I buy or should I sell? You see, you'll find a lot of people pull up an indicator, and when they're trying to trade, what they're looking for is, okay, this indicator, am I supposed to buy or am I supposed to sell? No. What we're about to teach you today is a different aspect of trading indicators. In this case, you will be asking indicators where you can buy from and where you can sell from, which means we are not going to be asking indicators to tell us if we're meant to buy or if we're meant to sell. We're going to be asking indicators to tell us where we can take a buy from and where we can take a sell from, which means we are not teaching this in isolation. You must still understand that you must still give preferences and references to the point of making decisions in the market, which means market analysis remains a factor that you must always consider in trading. So the starting point to whatever you're going to be doing, especially in the Forex market, is to analyze the market. That's always the beginning. Analyze, get information, know what is going on in the market. That is, see what is driving the market. What do you expect to drive this asset? Where do you expect it to be driven to? Are you expecting prices to rise, or are you expecting prices to fall in the market? But eventually, having decided the direction you want to go, there's also one more thing you need to add to the place of trading, the direction to which you can also enter into your trades. Which means we're talking about the fact that having decided to buy or to sell in the market, we then need to know where we can enter. And one of the major things, or one of the major tools that you can consider in this respect, is the moving average. But at the same time, we need to also ask ourselves, what exactly is the function of the moving average? Because a lot of people don't know. They just know moving average and they feel like it's just something that you just add to your market, and then that's all. You can begin to use it to do whatever you want to do. In the first place, a moving average is actually known to smoothing out the direction of price, which means it is actually expected to tell you in a cleaner way how prices are moving, if prices are trending, if prices are moving sideways, which means it filters out the noise in terms of movement. Candlesticks could be messy. There could be plenty, they could be modeled up together, but when you add a moving average to a screen, what you will notice is it will smoothing out that direction of price for you. It would be able to tell you if prices are actually rising, if prices are trending to the upside, or if prices are trending to the downside. Which means in its own respect, it has its peculiarities. You're looking to see if a market is trending, you could use the moving average to check that. You're looking to see if a market is trending upward or trending downward, you could also use the moving average to see that. You're looking to see if there is a change in the trend in the market, the moving average could also offer you that in the market. Not only can it do that, it could also offer you something we call support and resistance. For some of you who've been to some of our educational centers, you know that we've always taught you about price action always talking about levels to which prices could always find support, levels to which prices could always find resistance. But the truth is you might struggle with it at the beginning. In the beginning, you might actually find it difficult to identify some of those levels. But let me also tell you today, not only can moving averages show you trends, show you the beginning of a trend, also offer you when there's about to be a reversal. One thing it could also offer you is support and resistance. And finally, it could also offer you a guide to which you can enter into the market. Now, let us start with a few things that you need to note, especially when trading, using moving average. Number one, I want to start from the aspect of how moving average could help you as a form of a support level and as a form of resistance, and how you could also use it to enter into your trades in the market. In the beginning, what exactly is a support? What exactly is a resistance? For those of you who don't know, we won't go too deep into that. I think we have a webinar already recorded for you on YouTube, to which you could find out, support and resistance and how you can use that to also enter into your trades in the market. But here, it's simple. A support level is a level where you can expect prices to rise. And a resistance level is a level where you can expect prices to fall, which means when we're talking support, we're talking a level where prices will rise from. When we're talking resistance, we're talking levels where prices could fall from. But listen to this. Now, there are different ways to which you could find a support level or a resistance level in the market. There are horizontal levels of support. There are even trend line in form of support and resistance in the market, where you could always look out for opportunities to which prices could always rise and prices could always fall. But one thing you want to understand is the moving average could also offer you something in this respect. Now, in the first place, when prices are trading above a moving average, it is usually indicative of the beginning of an uptrend, which means you can expect that prices could find, further supports to rise in the market. So in the first place, when prices are trading above a moving average, one thing that should come to mind is, okay, this could mean, or this could be indicative of the beginning of a bullish movement of prices in the market. When prices are trading below the moving average, it could be indicative of a bearish movement of prices in the market, which means we're not expected to mistake them. When prices are trading above the moving average, it is clear, it is indicative of the beginning or a continuation of a bullish trend in the market. When prices are trading below the moving average, it is also indicative of the beginning of a bearish trend in the market. For example, if you let us just go through some part of the chart, let's look at some things. This is what we're talking about. You see situations where prices are able to climb above the moving average like this. It is always a point where we expect that something bullish is about to kick off with price. So if you look at something like this, once we find price successfully move above a moving average, we know, oh, this could be indicative of the beginning of an upward swing in price. And also, maybe other situation, okay, look at something like this as well, right? Look at something like this. The moment price was able to cross above, you could see how prices, clearly moved above. Let's look at some other ones. Oh my God, look at the beauty of this. Look at the moment price was able to cross above this. Look at what happened with time. So you can see that usually the moment prices are trading above a moving average, it is usually indicative the beginning of, an uptrend in the market. Now, let's look at some other ones. Let's just see if we can find a downtrend somewhere. Oh my God, look at the beauty of this. The moment price was able to successfully move beyond this, you can see that at least for the next how many days, we saw that prices continued to move lower. So in the first place, prices trading either above or below the moving average in the market is usually indicative of the beginning of a trend. It could either be an uptrend or it could also be, a downtrend in the market. For those of you who are more focused on how to help you set up a moving average in the chat box, please pay attention to the session. When we get there, we're definitely going to talk about it. You don't need to rush the class. Pay attention to what is being taught. I've seen a lot of comments, messages. How do you set this? How do you set this? When it is time, you'll definitely be shown that. Pay attention to what is being taught. As I was saying, so usually when we see prices, either move above the moving average or move below the moving average, it is usually indicative of the beginning of either a bullish trend or a bearish trend in the market. So we're looking at, some, examples on the screen. We've seen how that has played out on AUD USD for a while. Now, having seen that, how then can we use the moving average as, an entry tool? Because the purpose of talking about moving average here right now is not because I just want you to know something called moving average. I want to talk about how you can use it as an opportunity to which you can get, some really nice trades in the market. That's what I'm looking for. Now, how do we do this? Now, in the first place, this is how we do this. So take, for example, please follow me. I need you to follow me because you don't want to, miss me in the middle of what I'm doing. You've made your analysis, you've conducted your analysis, and your analysis in the market is suggesting that you buy AUD USD. So stay with me. AUD USD from analysis is a buy. Now, if you want to use the moving average strategy, one thing you must always look out for is watch out for the fact that price must be trading above the moving average. Price must be trading above the moving average. So in the case where your analysis in the market is suggesting a buy, fine, all good and fine. Now, if you get to the chart, you want to use the moving average strategy to enter into the market. The first thing is confirm that prices are actually trading above the moving average, not below the moving average. If you want to use the moving average strategy, price needs to be trading above the moving average. Now, when prices are trading above the moving average, you can again look for an opportunity to enter into a buy in the market. But if you're not able to find your own entry after confirming the prices, are trading above the moving average, there's another way to which you can do it. Listen, the moving average is expected to serve as a support level to serve as a support level when prices are trading above it. What this means is, if prices are trading above the moving average, you can expect that the moving average itself will be serving as a support level for price, which means in the first place, I want to buy. Let us say, for example, we got information from Australia today, maybe in form of an economic data, confirming the presence of a stronger AUD compared to the US dollar, which means I want to buy AUD USD, number one. Number two, I must also see that prices are trading above the moving average. If prices are not even trading above the moving averages yet, fine. You need to also wait until it crosses above it. The moment it crosses above it, you can look for an opportunity to buy. But as long as it is still trading below the moving average, you cannot find an entry opportunity yet. So now, having confirmed that prices are trading above the moving average, you could also expect that the moving average itself can serve as a support level for price. Now, this is what I'm talking about. Remember that as a buyer, support is the best place to buy from, which means for someone who wants to buy in the market, a buyer must always be looking for a support level. And if a buyer is always looking for a support level, the moving average could serve as that support level. The moving average could serve as that support level. It could. So in this case, it means, for example, let us see some examples. Look at something like this at this point. Let me show you a few of them. Look at something here. Now, imagine if you wanted to buy, AUD USD. Let me show you an example. Imagine if you wanted to buy AUD USD and then price crossed above the moving average here. Do you know that the moment price retraced back to the moving average, what the moving average did here was to serve as a support level for price? Which means if you miss out on a particular opportunity on a buy in the market, if you miss out on a particular opportunity on a buy in the market, you could still wait for a retracement to the moving average as a support level for you. What this means is, look at what happened here. Price moved above here, came back for a retracement of the level, but then the moving average acted as a support for price to rise, which means this was an entry point higher on this particular price level if we wanted to buy AUD USD. Now, if you look again, let's look for some other options. Let's look for some other options. Let's show you some other ones. Look at some other ones. Look at it here again. Price moves above, come back again, using the moving average as a support, again, moving above, coming back again, using the moving average again as a support level to rise, which means these were entry points for a buy. Just using the moving average as a support level for price to push higher, which means if I knew that I wanted to buy AUD USD, right? But unfortunately for me, price has crossed the moving average. It has even gone above it. You're not like, oh my God, how can I still enter into this trade? Instead of jumping into the market and jumping in on a wrong level, one thing you could watch out for is a retracement back to that moving average as a support level for you. We taught you retracements. Retracements are temporal movement away from, the original direction of prices, which means in case where you've missed out on a move, you can still expect that if prices retrace back to that moving average, it could still present you another opportunity for you buy because it is expected to act as a support level. Not only that, let's show some other ones. Look at this. Look at nice, oh my God. Look at nice levels. Look at this. Price moves above, offers us a retracement to this level. Price found support, it was able to rise, isn't it? Again, for example, you couldn't have entered at the peak. Price again offered us another retracement back towards the moving average. Again, what happened? Price was able to rise. Not only that, price still offered us again another retest of that moving average again as a support level, again helping price to rise. So the moving average will naturally act as a support level for prices when it is trading above it. So in the cases where you want to buy an asset, in cases where you want to buy a particular currency pair, number one, you need to confirm that prices are trading. Please give me a minute. So we need to confirm, number one, that prices are trading above the moving average. The moment price crosses above the moving average, you could actually enter into your buy. But if you are the careful type who does not like jumping in just immediately price moves above the moving average, one thing you can look out for is using the moving average itself in form of a pullback or a retracement, using the moving average as an entry point in form of a support. It's its job. It can do that for you. So the moving average could act as, a support level for prices to rise in the market on a retest. So if you confirm that the market is an uptrend, number one, if you're not there, or if you're there when prices move above the moving average, you can enter into your buy. But let's say you have missed out on the move. Don't worry. You can still wait for a pullback to the moving average, asking it to act as a support level for you to enter into your trades. But remember, the beginning is you must have done your analysis. So let's take another example. In the case where your analysis in the market is for you to is for you to sell AUD USD, we're going to change the metrics here. For you to sell, price must be trading below the moving average, not above, below the moving average. And then also, the moving average is expected to serve for you a resistance level when prices are trading below it. So in a situation where prices are trading below the moving average and your analysis in the market is to look for a sell, you could always expect that as a seller, you could use the moving average as that resistance level for you to sell. You could use the moving average as that resistance level for you to sell. Let's take an example. Let me look for a sell direction somewhere around here. Oh my God, look at this beauty. Look at this absolute beauty. Now, look at this. So look at first thing first, price came below, right? Which means it became indicative of a bearish turn in prices in the market. Now, if you were the type who don't mind, you don't look at swing levels before entering positions, under normal circumstances, the moment price closes below the moving average, it is already indicative of a bearish direction. But oftentimes you might want to wait for, a quick retracement or a retest of that moving average. You can see what it is doing here, acting as a resistance for price. What did it do? It sent price lower. But again, price still offered you again another, movement back to that particular resistance level. Again, price moving lower. One more time, we offered again a retest of the level. But look at what followed suit. A very nice drop in prices. A nice drop in prices. But even afterwards, price still offered us another test of this level again, with the moving average still acting as a resistance for price to move lower. Look at your entry points. See entry here. See entry here. See entry here. for a sell, look at entry here as well. The moving average has the capacity to act as a support for you and a resistance for you in the market. It's just a strict set of rules that you need to put together, that you need to hold on to. What am I talking about here? If your analysis in the market, which means you must have conducted the analysis, is suggesting a buy, wait for prices to move above the moving average. If it does, you can look for an entry into the market. But if you miss out on entering the moment price closes above the moving average, you could always wait for a retracement back to the moving average. It is expected to serve as a support level for you to rise. If your analysis is saying a sell, no problem. Confirm that prices are trading below the moving average. The moment prices moves below the moving average, you can look for an opportunity to sell. If you miss out on that, you could wait for a pullback or a retracement back to the moving average in order for you to look for further downsides in the market. This is indicative of how it works. It is beautiful to see how, if you pay attention to some of the rules, you could get interesting entry opportunities in the market. Now, the moving average I'm using on the screen is actually the 50 moving average, which is the one I'm going to be recommending to you. You could use some other ones, but we use the 50 moving average. If you want to set up your 50 moving average, you just press insert, indicators. On the trend, you'll find moving average. It's just 50 and it's simple. We use simple 50 moving average, all right? Just a simple 50 moving average. When you do that, you press OK and it's gone. All right, so if you look at it, it is interesting. Oh my God, look at the beauty of how this guy has served as a support level, resistance level for price. Look at it in the market. Even look at it here. Look at it here. You know, offering you levels to which you could still come into the market when prices are trading above the moving average, and even when prices are trading below the moving average. Oh my God, look at this absolute beauty. Price moves below, offers you a retracement back to that level to retest it, you know, and then downsides. Look at that. Look at that there. Absolute beauty. Look at that there. Oh my God, look at this. Oh my God, look at this absolute beauty here. Look at this. Price moves above, offers us a retracement, moves above, again offers us a retracement back, moves above, again offers us a retracement back, moves above, again offers us again another set, moves above, again offering you different opportunities to which you could have gotten in on the pen. Look at entry point here. With the moving average itself acting as a support level for price, look at entry points. So if your analysis is saying a buy, fine. The moving average or price must be trading above the moving average, indicating that there is actually the presence of a bullish trend in the market. Then get into the market if price is able to close above the moving average. If you miss out on the first move, no wahala. You could always be expecting to use the moving average as further entry points in form of a support level. Every retest of that position will be enough for prices to rise. It works the same way if you want to sell. The absolute beauty on this. I don't have so much time to keep talking about moving average, but two things I want to talk about. Now, another way you could also, apply the moving average to your trading is the moving average could also assist you in knowing the beginning of a new trend in the market. That is, you could also use it to know if there's about to be a bullish trend. You could also use it to know if there's about to be a bearish trend in what we call a golden cross and a death cross. It's 50. For those who are still asking, it's 50. In what we call a golden cross and a death cross. A golden cross is expected to form if there is about to be a bullish trend in the market, and you should see a bearish movement in the market when you find a dead cross. Now, usually this rule is not strict. For a dead cross to happen or for a golden cross to happen, a lower moving average needs to cross above an higher one or below it. What I'm talking about is this. I'm using 50 as my own lower, moving average. If I add an higher one, let's say a 200 moving average to this, 200. Let's give it another color. Maybe green will do. Great. Now, in the first place, golden cross. Lower moving average. Or the one you call short-term moving average. You understand? ST moving average. Moving above the long-term moving average. Now, like I said, this rule is not, how do I put it? This rule is not strict in the sense that I'm going to be using 50 and 200. My 50 for the short-term moving average, which is this color. This is my 50 MA, and the green one is the 200 MA, right? So I'm using 50 for my short-term time frame, and I'm using 200 for my long-term time frame. You long-term SMA, you can use 20 and 100 or 50 and 100. Like I said, it's not strict, but it just means that a short-term moving average must move either above or below the long-term moving average. Now, if you look at what happened here, this is what we call a golden cross. Look at it here. Here, a golden cross happened. It was the moment the 50 moving average moved above the 200 moving average. So the short-term moving average moved above the long-term moving average, which is 200. And that was the beginning of a solid bullish trend in the market. If you look at it, what followed was a very nice bullish price movement in the market. Look at it now. It is visible. The moment price had the cross, you can see, price continued to give us very nice bullish price movements in the market. So another way you could know the beginning of a bullish trend in the market is through the golden cross. That is, when your short-term moving average moves above your long-term moving average. Like I said, it could be 20 crossing 50, it could be 50 crossing 100, it could be 50 crossing 100 or 50 crossing 200. I'm using 50 crossing 200. If you want, you could also use that, you understand, but it's not strict as it must be 50 crossing 200. You could use whichever one you use, all right? But when the short-term moving average crosses above the long-term moving average, it is a golden cross. And that is usually indicative of the beginning of a bullish trend in the market. It is usually indicative of the beginning of a bullish trend in the market. But the one we call a dead cross. The dead cross is when your short-term MA moves below, don't let us use moving, moves below the long-term MA bearish trend or a downtrend. So if you're looking for, a dead cross in the market, it is usually when the 50 crosses below the 200, or the short-term moving average crossing below the long-term moving average. Look at it here. This is an example. Remember, this is the 50 here, MA, and this is the 200 here. So the moment we had the death cross here, look at the death cross, it was here. There's the death cross. You could see that it solidified the presence of a bearish trend in the market. Price came, offered us a retracement back, dropped, again offered us a retracement back, and then also continued its move lower. So usually, if you're also looking for the beginning of a bearish trend in the market, it usually happens when your short-term moving average moves below your long-term moving average. Like I said, the rule is not strict, which means it is not compulsory 50 and 200. It could be 50 and 100. It could be 20 and 100. It is within your own jurisdiction in your trading. All right. So it's not strict. But for me, I'm just personally a fan of 50 and 200. You could try out 50 and 100 if you want, right? So you could also try out 20 and 100 if you want, but I just love using the, the 50 and the 200 in the market. So the bullish cross, the bearish cross in the market could also be something that you could also add to your trading. It could help you see the beginning or a change in market trend. It would help you know if an uptrend has turned to a downtrend, or a downtrend is turning to an uptrend. For example, look at what happened here. And since it happened, this one here was, a golden cross, the 50 moving above the 200. And since then, if you watch, since then, price has been above, just going up. It only changed here. For a long time, since we had the golden cross at this point, since like 2nd of May, price has been maintaining a solid bullish movement in the market. It didn't go below the 200 again until recently, where you can now find a dead cross, although it didn't last too long as well. There was a dead cross here, although it didn't last too long. But it did happen, and we did enjoy ourselves for a short period of time. Price did go down before directions changed again. But remember, we are not teaching you this so that you can use it in isolation. You wouldn't do yourself so much good. Just open up your chart, just put moving average. You're just looking for golden cross. You're just looking for death cross. You don't even have any analysis you're doing. You don't know if you're supposed to be buying AUD USD. You don't know if you're supposed to be selling AUD USD. Like, you don't even know anything happening with prices in the market. It might not be as effective as it needs to be if you're combining it with your analysis in the market. So you need to combine it. You have to find a way to combine it. Know what you want to do. Understand the direction you want to take. Do I want to buy? I need prices to be trading above my moving average. And I could also expect that my moving average at a particular point in time would continue to act as a support level for me. If I want to sell, from my analysis in the market, I'm also expecting prices to be trading below the moving average. If that is happening, I could also expect the moving average to act as a resistance for me to get further moves into the market. And then you could also then watch out for golden cross, dead cross, that could also offer you the beginning of a trend in the market. Once again, the moving average that I use for my own explanation today is the 50 and the 100. The 50 SMA is the simple, and the 100, sorry, and the 200, the 50 and the 200 is what I used for my example today. All right, that's what I used. You need to hard it. You cannot identify it. You need to hard it. Insert indicators. Go to trends. You'll find moving average. You have to hard it yourself. Now, I don't have so much time. I must quickly switch. I want to talk to you about Fibonacci retracement. Sometimes, I think maybe 2 weeks ago, we had a webinar like this to which we discussed, trading retracement, breakouts in the market, and it was a really interesting session. But there is also a tool that can offer you really interesting insights into levels to which you can expect prices to retrace to before it resumes the original direction of price. Take, for example, please take, for example, I want to show you something quickly. Sorry, while we're still waiting for this to load, just to show you an illustration of what I'm talking about in this regard. It's taking so much time. Okay, great. I think we are here. Now, if you look at this, please confirm you can see my screen. Please just confirm you can see my screen. I just want one person to confirm that he or she can see my screen. Please confirm you can see my whiteboard. Okay, yes. All right, great. Now, ordinarily, when prices are rising or when there is a really nice bullish price movement in the market, you begin to wonder, do you enter into the market at the peak? No. Remember when we were teaching you about, support and resistance, peak levels are not levels where you want to enter into a buy. It is always going to be of good use for you to wait for retracement levels before you enter into the market. Now, listen to this. When prices retrace, it is not something that you can say it can only retrace this much before it continues. It could retrace this much. In fact, it could retrace this much before going back up, which means it is not actually easy for us to gauge where retracement is going to get to before price resumes its original direction. Now, ordinarily, a way we used to do it before is to look for support levels. For example, there could be multiple support levels in the market like this that you could identify yourself, and then you'll be like, okay, if price retraces up to this point, it could potentially continue to go up. This is a retracement here. This movement to this point is a retracement, right? But there is also the possibility that price gets here and it refuses to continue to go up. It could decide to move lower to a point like this before resuming its initial upside. You see, you might not even know how to draw good levels of support where you can expect prices to retrace to before it resumes its original direction of prices. You might not even know the likelihood of the levels that prices will get to and resumes its direction, but Fib is ready to offer you insight. The Fibonacci retracement tool is a tool that offers you insight into good levels to which prices can usually use to continue its original movement of prices in the market. Which means if I'm looking at something like this in the market, and I'm just wondering, where could price potentially retrace to before price continues its original direction? Because I know I cannot buy this asset where it is. I need it to retrace a little bit before it continues to go up. You can easily pull up a Fib. Now, there are some benefits of pulling up Fib in the market. Number one, it will draw you some strong levels of support and resistance that you might not even be able to identify by yourself. So it would help you map out some really sturdy levels of support and resistance. Number two, it offers you more psychological level to use in the market because it means other traders who are also using FIB would see the same level such as you, and it could also increase the probability of most traders in the market using the same level as an entry point. So not only is it going to offer you some strong levels of support and resistance, it would also offer you some really, really significant psychological level in the market. And also, it offers you two different directions to which you can trade price. Because you can use it to trade reversals, and you can also use it to trade continuations. Yes, for example, some people can use Fibonacci to trade the reversal in price, this price going down. So some people can decide to trade this point here to this point, and some people will decide to trade this point back up. This is the reversal move, or which is just a move away from the original direction of price, this point. Some people can decide to trade this, and some people can decide to wait for price here, only trade the retracement, and allow price continue to go up. So whichever one you want to be, you want to trade the reversal, you want to trade the continuation, no problem. FIB can offer you a better insight into things like that. So let us quickly go and look at how FIB works on a good chart in the market. Now, take for example, look at a screen like this. Now, let me start with something more, clear, like this. Now, number one, FIB is best used when you find a trend. FIB is not something that you just draw anytime you want on any kind of market. No. FIB is not just a tool that you will, for example, you cannot bring FIB here now and say, FIB here, like this. It's not like it won't work, but you're not giving it its full potentials. It is better to put FIB on a trend. Now, the trend is what will determine if or how you're going to draw the FIB in the market. For example, if you're drawing for a downtrend, you're looking for a recent swing high, which is this point, to a swing low. Now, what this means is because it's a downtrend, you can't draw it this way. It will be wrong. If you draw it this way, you are not helping yourself. No. It is strict one way or the other in its drawing. So you can't draw it anyhow. You have to draw it based on the trend you are seeing and that you want to calculate the retracement for. So it is like this. If it is a downtrend, you are going to draw it from the swing high you can find. That is the highest point you can find, which is at this point, to the lowest point you can find, which is at this point. Now, your FIB is always available on the screen, just somewhere around here is this F. You just pick it like this, and then you draw up to this point, the lowest point here. Great. Now, what are you looking at on your screen? See your screen. 61.8. 50.0. 38.2. 23.6. Now, listen to this, and then 0 here, which is actually the last point you can look at. In the first place, the original direction of price that you're looking at is a downtrend, which means this is, in the first place, a market controlled by sellers in the first place. which means if you're buying this market, it must be that you're trading against the trend. That's what it means. If you decide that you're going to buy this market, it must be that you know by yourself that you're trading against the market trend. Why? Because this in itself is a market controlled by sellers. Which means if I do my analysis and I get to find out that what I want to do is to sell USD CHF, I'm looking for an opportunity to sell, but I also cannot sell from a support because this is a support. And that is why prices are currently rising, because I can't sell from here. Price entered into a support zone, so I knew I cannot be selling. I know that in order for me to sell, price needs to retrace back to a resistance for me to take a downside. But I don't even know where price can potentially retrace to before it continues its downside. Is the reason why you withdraw fee. Now, this is what Fib is saying. Fib is saying there's a possibility that this happens. 1. Or this happens. 2. Or even this happens. 3. In fact, this happens. 4. Multiple levels that Fib is presenting to you as a potential point to which price can resume its downside, which means price can retrace up to 23.6 and continue its downside. 1. It could also get to 38.2, continue its downside. 2. It could also potentially retrace as much as 50.0, continue its downside. 3. Or even as high as 61.8 before continuing its downside, which means this is an entry point, E, for a sell. This is also an entry point, E, for a sell. This is also an entry point, E as well, for a sell. This is also an entry point, E. But listen to this, 4 different levels. Which one do you use? Because trading is probabilistic in nature, which means it cannot give you one answer and say this answer is compulsory. It is the only level that price can use to continue its downtrend. It can't say that. It won't say that. It won't say one and say only this one. No, it is giving you multiple entry levels to which price in of itself can continue its movement lower. It is your job to wait and learn how you can use it to know where prices could potentially retrace to and resume its direction. Now, in the first place, it is not possible for price to get to 61.8 without crossing 50.0. It is also not possible for price to get to 50.0 without crossing 38.2. It is not possible. It is also not possible for price to get to 38.2 without crossing 23.6. Which means, first and foremost, the most likely point to which price would try to resume the original direction of price is 23.6. If price is able to pass 23.6, then you can expect 38.2. If price also is able to move beyond 38.2, you could also expect 50.0. But there is no guarantee, which means you must always look for elements of price action. Now, 2 things that you should always look for when you want to trade Fibonacci continuations in the market. Number 1, look for elements of price actions. For example, this is actually an element of price action. Elements of price action includes a range beyond around a level or something like this. Could also qualify as, evidences of price actions in the market. Maybe candles like this, and then you begin to form wicks, something like this for you, rejection candles. Rejection candles are also evidences of price action. Or when you see empty candles, which we call dojis as well in the market, these are evidences of price actions. So evidences of price actions on a level are indicative of the fact that Looks like something is about to happen from here. Looks like they are trying to protect this level as a potential level for price to resume its downside. When you don't find evidences of price action around the fib level, there's a very high chance that prices will most likely go beyond that level and look to test the next level. For example, if a market tests a fib level like this, you can't expect that you will just enter into your trade for a sell like that. There's a very high chance you will do something like this to go and test 38.2. There's a very high chance. If you now get to 38.2 and you see something like this, and you confirm something like this, a rejection, or maybe even a doji, as the case may be, like this, or even any of those reversal candles that you already know, but evidences of price actions around a level is what you must always watch out for in the place of trading. So when you're looking at using the fib, whatever fib level you're targeting, always ensure that you find evidences of price action there. Ensure that prices is not looking to break the level. The moment prices are able to break that level, you need to wait for the next one. And also, another thing that you could also add to this is your pre-knowledge of support and resistance. For example, for me, looking at this, I know the most likely level price is going to retrace to. It is this level, 38.2. If you ask me why, because for me, away from what fib itself is saying, look at this. This is a very strong level in the market. Also a very strong level. For me, there's not so much strength per my view on 23.6. I feel like the significance of 28.2 is more compared to 23.6. So I'm not sure if I'm confident that 23.6 is the right place to go. I strongly believe that this is going to happen. I strongly believe that this is going to happen for price to continue to go down. Listen to what I just said. I didn't say 23.6 is wrong. I'm saying look for evidences of price action on a level before you use it as a continuation for price movement in the market. But something else you could also add to it is look for those ones that by yourself you can find significant, price action on. This is significant level of price action. This one, very significant. This one, it's a significant level. So I really believe this could be, the next point to which price could continue its movement lower. So for me, I'll be targeting 38.2 even before price gets there. That's how to use fib. By the time price gets to 38.2, all I need is evidences of price action and coming into a sell. This is my entry point. You could also think maybe, what's it called? You could think pending orders if you want, all right? But at the same time, for me, personally, I feel like we are going to 38.2. 23.6 can still work if the level is able to hold price. Don't get it wrong. 23.6 can still hold price, but from the view, I don't think the price action around 23.6 is solid for me. I think a more solid level for me is 38.2, which I believe price will resume its original direction of price, which is to head to the downside. That's what we're trying to say. Now, let's take an example of an uptrend, for example. This is also a downside. This is one that you could also look out for. Say downside. You could see the way I drew it. I drew it from a swing high to a swing low. If you're drawing for downtrend, it must be a peak point you can find to the lowest point you can find. That's what it must be. It must be a peak point to the lowest point, although price is looking to breach this level, so I must extend. Now, if you look at what I have, price is still going lower, but I know that very soon it will be finding support. So how can I prepare myself for an entry? Well, number one, I know that there's 23.6 here. I also know that there's 38.2 here. And I also believe in retracements, which means if I'm able to find, a movement back up here towards 3.6, price could resume its continuation lower, or possibly movement from here to 38.2 as well could also give price an avenue lower, which means I am going to be stalking these two levels for now. That's how to look for trading opportunities using Fib. I'm going to be stalking these levels for now, that when price is able to offer me a retracement back here, I feel like it's a good level for me to look for further entry for downsides in the market. So I feel like these two levels are good levels to watch out for. Number one, this is a very solid level as well. If you look at this level, 38.2 is solid. It has solid price action. But at the same time, even 23.6 is also solid, also has some solid levels of price action there. A break took place, which means a normal, retest of that level is also expected. So I feel like these two levels are two levels that I think we could also look out for in the market right now using the Fib. So Fib is something that you could also add to your trading, offering you significant levels, support and resistance levels that prices could always use to resume its movement in its original direction, offering you high probability entries into the market. Like I said, it offers you some really nice psychological levels in the market. Here is an uptrend market. Well, let me isolate it a little bit. If you look at this, this is also a downtrend. How come I'm not seeing an uptrend? Currently, it's a downtrend. If I'm going to draw from the peak point here to this point. You could see price is starting to struggle around 50.0. Starting to struggle, which means if I confirm this level not to be broken, it could be a level for price to resume its original movement of price in the market lower. But because I have relevant information about AUDNZD, I'm not trading a downside on this asset. Please don't forget, when we started teaching, we said technical indicators should not be the one telling you to buy or to sell. They should be the ones telling you where to buy from and where to sell from. The place of analysis cannot be thrown away in what you're doing in this business, which means you don't open up a chart and just put Fib on it, except you already know the direction you want to chase in the market. You must already know what side you're looking for. Your analysis must have pointed you in a particular direction before you even think about, the direction to which you want to go in the market. It is one thing to look out for, please, in the place of trading. You don't want to just start pulling up moving averages, start pulling up Fib and just say, this is what I want to do. No. Don't let Fib be the one telling you to buy or telling you to sell. Let it be the one telling you where you can buy from and where you can sell from. So please still pay attention to analysis. This is an uptrend. So let me look for the lowest point I can find. I feel like I can use the lowest point around here for an uptrend on pounds JPY, just as an example of an uptrend. It means for pounds JPY, I'm really interested in this level. It's actually a very significant level, 23.6. If I get, a retracement from here back to 23.6, that can give me a very solid entry point on pounds JPY. But if price also decides to go through 23.6, the next one available is also 38.2, to which price could also use to go higher. This is also an entry point here for you in form of an uptrend. If you're drawing for uptrend, it must be from the lowest point you can find to the highest point. if it's a downtrend from the highest point to the lowest point, that's what it must be. If it's a downtrend, it must be from the highest point to the lowest point. If it's an uptrend, it must be from the highest point to, if it's an uptrend, it must be from the lowest point to the highest point. If it's a downtrend, from highest point to the lowest point. All right. So it offers you different levels to which you can, look at this level, very significant level. Both 38.2 and 23.6 on pounds JPY are actually very significant. If you look at it, there are actually some very solid zones in trading. Oh my God, really, really significant support level here for price. So it has a very good chance. Also, this one, very, very significant level also for price in the market. So it's a really, really solid level that we can expect prices to resume its original direction in the market. All right. So this is very important. And what we've brought to you today, yes, the session is recorded. All right. So which means it will be available on YouTube very soon. All right. But I'm done with what I'm teaching, but I'm ready to take your questions right now. So some of you that already have questions that you've already put in, I'll try to read them and answer them. All right. But thank you guys for joining us today. But we're going to take in your questions and your answers now. Okay, we're going to take your questions and your answers. Take your questions and also give you your answers. Okay, take your questions and your answers.